Welcome to what I like to call the heartbreak of finance, cost of capital estimation. Why heartbreak? Because it's simultaneously the most important number in all of corporate finance and the most difficult to estimate accurately. It's like being asked to provide GPS directions during an earthquake while blindfolded. But here's the thing. Every major business decision depends on this number. Whether you're a CEO deciding between two projects, an investment banker valuing acquisition, or a consultant recommending strategic investments, you need to know the cost of capital. Today we're going to master this critical concept using the H.J. Heinz case, where you'll wrestle with cost of capital estimation during one of the most volatile periods in recent financial history. By the end of this module, you'll understand why CFOs lose sleep over basis points, and more importantly, how to estimate cost of capital like a pro. By the end of this lecture, you'll master, or module I should say, WACC calculations, the mechanics and the judgment calls, the component analysis, cost of equity and debt under uncertainty, market versus book values, the mistake that sinks valuations, sensitivity analysis, because the future is uncertain, shocking I know, professional communication, how to present ranges, not false precision. A CFO who gives you a WACC to 3 decimal places either doesn't understand uncertainty or is lying to you. These learning objectives aren't just academic checkboxes. They're the core skills that separate competent finance professionals from great ones. Let me share why each of these matter. WACC mastery. Every investment decision, every valuation, every strategic initiative depends on this number. Get it wrong by 200 basis points? You could approve value-destroying projects or reject value-creating ones. Component analysis. Understanding why the cost of equity is 12% instead of 10% helps you communicate with stakeholders and adjust for changing conditions. Market versus book values. I've seen analysts make million-dollar mistakes by using book values instead of market values. In 2024, this distinction is more important than ever with market volatility. Sensitivity analysis. The quote on the slide is real. Any CFO giving you WACC to 3 decimal places, like 9.847%, is either naive or trying to appear more precise than the methodology allows. And professional communication. You're going to learn to present cost of capital as a range with confidence intervals, just like the professionals do. Every major business decision, whether it's capital budgeting, valuation, strategic planning, performance measurements, they all factor in to making those major decisions. For example, in capital budgeting, we're asking, should we invest $100 million in this new factory? Or M&A evaluations, what's this acquisition target actually worth? When we talk about strategic planning, we're asking which business units create value. And performance measurement, are we beating our cost of capital? Let me give you some real examples of why this matters. You may have heard of WeWork. In 2019, part of their spectacular valuation collapse came from using unrealistically low discount rates in their projections. When investors applied appropriate cost of capital to their cash flows, the $47 billion valuation became obviously absurd. General Electric in 2017 and 2018, their problems were amplified because they had been using cost of capital estimates that didn't reflect the true risk profile. When reality hit, their cost of capital spiked, making many business units value destructive literally overnight. And Tesla, we've talked a lot about that. Tesla 2020 to 2024, Tesla's cost of capital has fluctuated wildly based on market perceptions of execution risk. when their cost of capital was 15% and more, many projects looked unattractive. Then as it fell to 8 and 10% with their improved execution, the same projects suddenly became highly attractive. Now, the math is unforgiving. A 200 basis point error might sound small, but on a $500 million project with 10-year cash flows, that's often a $50+ million valuation error. Deals can be killed or approved based on smaller differences. Bottom line here is cost of capital isn't just an academic exercise, it's the foundation of every value-creating decision in business. You can see here the simple formulas of calculating the weighted average capital cost. You see the formula here. EV, just a reminder, is equity weight. That's, in translation, market value. RE is your cost of equity. DV is your debt weight. Again, that relates to market value. RD is your cost of debt. And T, of course, is tax rate. Now, the WACC formula looks deceptively simple. It's literally middle school algebra. But each component requires sophisticated judgment, and getting any one of these wrong can destroy your analysis. So let me walk you through what's really happening here. First, I want to talk about the weights, EV and DV. This is where many students make their first big mistake. You have to use market values, not book values. Why, you may ask? Because market values reflect what it actually costs to raise capital today. Book values are historical. They tell you what capital cost last year, not what it costs now. For example, in 2024, many tech companies have book values that are tiny compared to market values because their assets are intellectual property, not factories. Meta's book value per share is around $40, but the stock trades at $500+. So using book values would wildly underestimate their cost of equity. Now, in the cost of equity, this is usually the hardest component. CAPM is the standard, but which risk-free rate? The 10-year Treasury was 5.5% in late 2023. Then it fell to 3.8% mid-2024. Then it rose back up above 4.5%. That 170 basis point swing directly impacts every cost of capital calculation. The cost of debt, the RD, don't use the historical average rate on existing debt. Use marginal cost. What would it cost to borrow additional money today? Credit spreads change constantly. And while the formula is your friend, judgment calls will make or break your analysis. CAPM is like democracy, the worst method except for all the others. Let me break down the real-world challenges here. Risk-free rate selection. This seems obvious until you face an inverted yield curve. In 2024-2025, 2-year treasuries yielded more than 10-year treasuries. If you're evaluating a 10-year project, do you use the 2-year rate, which is higher, or the 10-year rate, lower? The academic answer is match the maturity, but practitioners often use 10-year regardless because it's more stable. Now, I have what's called beta hell, and I call it beta hell because there's no right answer. Tesla's 2-year beta might be 2.1, but their 5-year beta might be 1.7. Which reflects their true risk? The 2-year includes recent volatility, but also includes their stock's meme stock period. The 5-year includes their struggling startup days. So the tip from me would be calculate multiple betas and then explain your choice. Don't just take the default from Bloomberg or Yahoo Finance. Market risk premium. This is where experience matters. The historical average since 1926 is about 6.8%, but that includes the Great Depression and multiple world wars. So is that really relevant for 2025? In 2024, when I calculated implied market risk premium from current S&P 500 valuations, I got around 4.8%. But CFO surveys showed most executives still use 5.5 to 6.0%. So who's right? Well, the answer is both in different contexts. So the main idea here, the key takeaway is document your choices and test the sensitivity. A range of 8 to 12% cost of equity is often more honest than a precise 10.3. So again, not your historical average. So the wrong way to look at something would be, our bonds issued in 2019 cost 3.5%, so our cost of debt is 3.5%. The right way would be able to say, what would it cost us to borrow additional money today? And this is where I see students make their second biggest mistake after the market versus book values. They look at their balance sheet, see bonds issued at 3.5% in 2019 and think, great, our cost of debt is 3.5%. However, this is wrong. That tells you what money costs in 2019, not what it costs today. In 2024, Disney had bonds outstanding from various years, ranging from 2.75% to 4.12%. But when they needed to raise additional debt in mid-2024, they paid over 5% because credit spreads had widened significantly since those older bonds were issued. So there's a couple of different methods of how to get the real cost of debt. And I want to go through a couple of these. And then you will adapt that based on what you're estimating. So method one, recent issuances. If Heinz issued debt in the last 6 months, that's your best estimate. Market conditions haven't really changed that much in 6 months. Method two would be current bank rates. Most companies have revolving credit facilities with current market rates, and that tells you what lenders think the company's worth today. Method three would be peer analysis. If Campbell Soup, with similar credit quality, just issued bonds at 5.2%, Heinz probably faces similar rates. And method four, CDS markets, credit default swaps, provide market-based estimates of default risk. We add that to treasury rates for the implied borrowing costs. And don't forget about that tax shield reminder. If Heinz can deduct interest payments at a 25% tax rate, their after-tax rate cost of 6% debt is really 4.5%. And so this tax benefit is why debt is often cheaper than equity. Now, the catastrophic error here, the $1 million mistake, is using those book values when you should use market values. Let me give you another example of this. You're valuing a tech startup's new AI project. The company has $100 million in debt, book value, and $200 million in book equity. Simple math says they're 30% debt financed. But the reality is this: the company's stock has exploded. They're now worth $2 billion in market cap. Their real capital structure is 5% debt and 95% equity. So using book values, you'd calculate WACC around 12%, but using market values, that would be calculated at around 10%. And so that 200 basis point error on a $500 million project, if we're using 10-year cash flows, creates roughly an $80 million valuation error. And so you may ask why students make this mistake, and really even some professionals. Well, for one, book values are convenient. They're right there on the balance sheet. Another reason is market values change daily, and that creates discomfort for people who are super precise. You often see in textbooks examples using book values, and they're really just doing that to keep the math simple, and students misinterpret that as the way the real world works. But the harsh truth is market values represent what capital costs today, what it actually costs today. and book values tell you what it cost historically. Which matters for investment decisions? Obviously, current cost. So would you price a house based on what a previous owner paid 10 years ago, or what similar houses sell for today? Exactly. The bottom line is always, always, always use market values for WACC weights. This single insight is going to save you millions in your career. So how do you estimate cost of capital when everything is uncertain? Well, welcome to the current environment, where everything we thought we knew about cost of capital estimation has been turned upside down. First, we have the interest rate roller coaster. In early 2022, the 10-year debt treasury was around 2%. By late 2023, it hit 5%. Then it dropped back to 3.8 in mid-2024. And now it's back up above 4.5%. So if you calculated WACC in January and used it in December of the same year, you could be off by 200 or more basis points through no fault of your own. Market risk premium chaos. The historic average market risk premium is about 6 to 7%, but implied risk premiums from current market valuations suggest 4 to 5%. Now, the survey data, as I mentioned earlier, shows CFOs using 5 to 6%. And when you're trying to figure out who's right, the answer is it depends. They all are, depending on your perspective and your time horizon. When markets are volatile, beta becomes less reliable. Netflix's beta swung from 0.8 to 1.4 and back to 1.1 just in 18 months as markets reacted to streaming competition, then recession fears, then AI optimism. So embrace uncertainty instead of pretending it doesn't exist. Use scenario analysis, test sensitivity, present ranges, and update this regularly. In your H.J. Heinz case study, you're going to navigate this uncertainty and provide practical cost of capital guidance for real business decisions. All right, now let's walk through your Excel template systematically. Think of this as a 6-story building where each floor serves a specific purpose. Sheet 1, that executive summary, could be the executive suite. This is up at the top where busy executives are going to look first. They want the answer immediately with enough detail to understand the key drivers. Your WACC summary should show the final number with a confidence range, plus visual breakdown showing how much comes from equity cost versus debt cost. Include conditional formatting so if your WACC is way above or below industry benchmarks, it'll flash a warning color. I've seen a lot of analyses with the WACC estimates that were obviously wrong, but nobody caught it. Now in sheet 2, this is the research department. This is where you document everything. Which treasury rate did you use? From which source? On what date? Why did you choose 10-year over 2-year? Someone should be able to recreate your analysis months later using only your documentation. In real jobs, you'll be asked, how did you get that number 6 months after you built the model? So you want to have that in case your brain loses that information, like mine typically does. In sheet 3, we could call this the laboratory. This is where you test different methods and reconcile them. CAPM might give you 11%, dividend growth models gives 10%, and risk premium approaches gives 12%. How do you reconcile these? Well, this sheet helps you work through the logic and defend your final choice. Remember, the goal isn't to get 3 methods to agree perfectly, it's to understand why they disagree and make an informed judgment. In sheet 4, we could call that the cost of debt workshop. What would we pay today? We're looking at current debt structure analysis, credit rating implications, marginal cost estimation, after-tax calculations with validation. In sheet 5, that's our WACC Integration Center. That's where we're putting it all together. Market value weight calculations, the current versus target structure analysis, the final WACC with multiple scenarios, and sheet 6 is your reality check. This is the most important sheet for real-world application. It tests how sensitive your WACC is to key assumptions. If changing your beta from 1.2 to 1.4 changes your WACC by, say, 100 basis points, that tells you that beta estimation is critical and you need to be extra careful about it. Now, the Monte Carlo simulation is considered an advanced feature. This runs through thousands of scenarios with different assumptions and combinations, and it gives you distribution of possible WACC values instead of a single point estimate. So let's talk about how the cost of capital plays out in some real companies that you are familiar with. Apple. They're like the anomaly. Apple's cost of capital is artificially low because they have 150 plus billion in cash. Their optimal capital structure would include much more debt to capture tax benefits, but they maintain financial flexibility for strategic acquisitions and economic uncertainty. Their WACC calculation is almost academic because they fund everything with cash. Apple's low cost of capital allows them to invest in projects that competitors can't justify spending money on. When your WACC is 7.5% and the competitors is 12%, you can profitably enter businesses they can't even touch. Now, Tesla would be an example of the enigma. Tesla's cost of capital has been all over the map. In 2018 and 2019, when people questioned their survival, their cost of equity was probably 15% plus. But in 2021, during peak EV euphoria, it might have been 8%. Now it's somewhere in between as markets assess their AI and autonomous driving prospects. So the challenge here with them is, how do you make long-term investment decisions when your cost of capital changes with market sentiment? Tesla has learned to fund growth during low-cost periods and preserve cash during high-cost periods. Ford, my third example, I like to call this the reality check. Ford's cost of capital reflects the brutal truth of legacy businesses. High pension obligations, cyclical industry dynamics, and massive EV transition costs all increase their risk profile. Their 10 to 12% WACC means they need higher returns than Tesla to justify the same investments. This cost of capital disadvantage forces Ford to focus on higher margin, lower risk projects, while Tesla can pursue longer term, higher risk innovations. So your written assignments for this week is not a traditional academic paper. It's a business memo to a CFO who needs to make real decisions with real money. Let me tell you what she cares about. Sarah Chen gets 50 emails a day and sits in 8 hours of meetings. She needs the answer in the first paragraph in this executive summary. Based on current market conditions, Heinz WACC is estimated between 8.5% and 10.5%, with a base case of 9.2%. Done. Everything else becomes supporting detail. In the methodology section, that's where you demonstrate that professional competence. Don't say, I used CAPM. Explain why you chose 10-year Treasury over 2-year. Why you used 2-year beta instead of 5-year. Why you weighted market risk premiums the way you did. Real-world context matters. Given the inverted yield curve environment, I selected the 10-year Treasury rate for consistency with project evaluation horizons, while acknowledging this creates near-term uncertainty as the curve normalizes. Okay, that's a sample of what that would look like. The uncertainty analysis. This is what is going to separate professionals from novices. Don't pretend you have the exact answer. So, for example, it might sound something like this. The primary sensitivity is to market risk premium assumptions. If economic certainty increases risk premiums by 100 base points, WACC would increase risk to 10.2%, potentially changing project approval thresholds. In strategic implications, connect your analysis to actual business decisions. For example, this WACC range suggests current project hurdle rates of 12% may be appropriate, providing a 200 to 300 basis point buffer for execution risk. And lastly, your writing style should be professional but conversational, confident but acknowledging uncertainty, data-driven but business-focused. Now, in this Excel spreadsheet this week, I'm just going to front run this and tell you this is going to take you some time. In sheet 3 alone, the cost of equity calculations could take you 45 minutes. Your cost of debt analysis could take you 30 minutes. So plan to spend 2.5 hours or a little more on this particular part of your assignment. So here's how you can be efficient with this. Start this out using sheet 2. Get your assumptions right first. Use those template formulas. You don't have to rebuild what's already there. And document as you go. Add assumption notes immediately, because if you try to go back later and add that in, it just gets messy. Be sure you validate continuously. Check reasonableness after every major calculation. And of course, save frequently. Sometimes if it's a complex model, this stuff can crash. So save, save, save. Also, I wanted to go back in that documentation part. Be sure you add those comments to the cells as you work. I want to talk about some common mistakes, okay? Let me give you some examples of technical disasters. I used book values because they're more stable. I used 5-year average treasury rates to smooth out the volatility. I forgot the tax shield on debt. My beta came from 2019 data because it was more reliable. Judgment errors I see are some examples. WACC is 9.34% based on my calculations. Well, that's false precision. I use the same WACC for all business units. Well, the reason this is a problem because risk differences are ignored. Market conditions don't matter because CAPM is theory. Well, theory does meet reality. Here's some communication errors that I see. WACC is somewhere between 7 and 13%. This is too wide to be useful. Or, I calculated 3 different answers, so I averaged them. That's just lazy methodology. Or, and I see this a lot, the model shows. Models don't show anything. You interpret them. The H.J. Heinz case mirrors what every finance professional faced during 22 to 2024. You're not calculating WACC in a stable textbook environment. You're doing it when interest rates are changing every month, market volatility makes beta estimates unreliable, credit spreads are widening due to economic uncertainty, traditional relationships between variables have broken down. And what makes this hard? This case gives you limited data and asks you to make practical recommendations under uncertainty, just like real life. But what makes it valuable? You'll learn to handle ambiguity, document assumptions clearly, and communicate uncertainty professionally. And those are the skills that separate excellent analysts from average ones. So, for a successful mindset, don't aim for the right answer. Aim for a defensible, well-reasoned analysis that acknowledges uncertainty while providing practical guidance. Your goal here is to demonstrate that you can provide sophisticated financial analysis under realistic constraints. This is what you'll do with your first job in finance. Let me give you the formula for an excellent written analysis that is going to make this project a success for you. In the executive summary, the magic formula looks like this. Answer the question directly in the first sentence. State your methodology briefly but very specifically. Acknowledge the key uncertainty, shows you understand the challenge. Provide implementation guidance, showing you understand practical application. So a bad executive summary would look like this. This analysis estimates Heinz's cost of capital using various methods. But a good executive summary would start like this. And please don't plagiarize my words. Heinz WACC is estimated at 9.2% with a confidence range of 8.5% to 10.5% based on current market cap M analysis with comprehensive sensitivity testing. Given economic uncertainty, recommended using 11% project hurdle rates to provide appropriate buffer for execution. In the methodology section, don't just describe what you did, explain why you did it. For example, I selected the 10-year Treasury rate, 4.2%, over the 2-year rate, 4.8%, despite the inverted yield curve, because project evaluation should use long-term risk-free rates consistent with project cash flow horizons. Always connect technical choices to business implications. For example, this beta selection increases cost of equity by 50 basis points compared to the alternatives, which would raise project hurdle rates and potentially eliminate marginal investments. Keep that professional tone confident but humble, data-driven but practical, and sophisticated but accessible. Now I want to share some battle-tested wisdom for avoiding some Excel disasters that have haunted students and even professionals. First, color coding discipline. The template uses color coding for a reason. Yellow cells are the only places you should type numbers. Blue cells contain formulas. Don't overwrite them. I've seen students accidentally delete complex formulas and then panic when their model breaks. The great reference disaster. Students sort data without selecting the entire range. Suddenly, revenue data is matched with the wrong company's margins. Always select the entire data ranges when you're sorting. Be careful with your reference, the circular reference catastrophe. Students link output back to input, and that creates a circular reference. And Excel will either crash or give you meaningless results. And then, of course, there's the format fiasco. If you enter 10% as 10 instead of 0.10, and then you wonder why your WACC is 1,000%. Another error is validation. Always do sanity checks. If your WACC comes out at 25%, stop and figure out what went wrong. If your cost of equity is lower than the risk-free rate, you've made an error. Your Excel model represents your personal brand. Sloppy formatting suggests sloppy thinking. Clean, professional models suggest competent analysis. Sensitivity analysis is your insurance policy against being wrong. Let me show you how professionals use it. What to test and why. Risk-free rate plus 100 BP. Treasury rates move 200 BP in 2024 alone. Your analysis needs to work even if rates changed after you submit it. Market risk premium plus or minus 150 BP. This has the biggest impact on cost of equity, the difference between using 5% and 6.5%. MRP is often 150 basis points of cost of equity. Beta plus or minus 0.2 units. Beta estimation error is typically 0.1 to 0.3. If your result changes dramatically with small beta changes, you need to be extra careful about beta selection. If change in market risk premium from 5.5% to 6% changes your WAC by 50 basis points, market risk premium selection is critical. Spend extra time here researching and justifying your choice. Low sensitivity example. If changing credit spread by 50 basis points only changes WAC by 5 basis points, don't spend hours refining your credit analysis. Now, in your professional communication, instead of saying WACC could be anywhere from 6 to 14%, which is useless, say WAC ranges from 8.2 to 10.8% across reasonable market scenarios, with 9.2% representing our best estimate given current conditions. And then the business application, CFOs use this range to set project hurdle estimates. If your WACC base case is 9.2%, but could be as high as 10.8%, they might set hurdle rates at 11.5 or 12% to provide buffer for both estimation error and execution risk. Remember, sensitivity analysis is not about being indecisive, it's about being honest about uncertainty while still providing actionable guidance. Now, let me share some real war stories that illustrates what happens when cost of capital analysis goes wrong. Now, let me just say this, the names have been changed to protect the embarrassed. All right, the private equity disaster. A major PE firm was acquiring a restaurant chain in 2021. Their analysis calculated cost of equity using beta data from 2019, before COVID hit. Pre-COVID, restaurant chains had betas around 1.2%. Post-COVID, they had betas around 1.8 due to operational leverage and cash flow volatility. So using old beta, they estimated the cost of equity at 10%. Using correct beta, should have been 13%. Now, on an $800 million acquisition, this 300 basis point error led to roughly $150 million in overpayment. The deal still happened, by the way, but returns were much lower than projected. And the lesson in this example is major structural changes like pandemics require updating all of your risk assumptions, not just the obvious ones. All right, my next example is the tech startup comedy. A well-meaning analyst was valuing an AI startup and noticed they were both technology companies like Microsoft. So they used Microsoft's cost of capital, around 6% at the time, for the startup. But here's the problem. Microsoft has stable cash flows, global diversification, and AAA credit quality. The AI startup had no revenue, 3 competitors, and 6 months of cash runway. Their cost of capital should have been about 15 to 20%. So what was the result? They approved multiple R&D projects that looked attractive at 6% discount rates, but were value destroying at realistic 18% rates. All right, my last example here, the credit rating surprise. A corporate development team was evaluating a major acquisition in 2024. They calculated cost of debt based on the company's BBB rating from earlier in the year. During their analysis period, rising interest rates and industry concerns led to a rating downgrade to BBB minus. So the result or the impact, the cost of debt increased from 5.5% to 7.5%. And this increased the WACC by about 60 basis points, making the acquisition much less attractive. Ultimately, that deal got canceled. So the lesson here is cost of capital isn't static. It will change with market conditions, company performance, and macroeconomic factors. So you've got to build monitoring into your process. Now I want to say this. You're learning cost of capital during one of the most challenging periods in recent financial history. This is actually an advantage for you because you're developing skills under fire that will serve you well throughout your career. Current market weirdness is this inverted yield curve. In normal times, 10-year rates would exceed 2-year rates because longer-term investments require higher returns for additional risk. But in 2024 and early 2025, this relationship flipped. The 2-year Treasury yields more than the 10-year. And that breaks some traditional cost of capital assumptions. Do you use the 2-year rate, higher but short term, or a 10-year rate, lower but more appropriate for long-term projects? There's no perfect answer, which is why you need to justify your choice and test the sensitivity. There's Fed policy confusion. Markets are constantly trying to guess Federal Reserve intentions. Will they cut rates by 50 basis points or 100 basis points? This uncertainty creates volatility in risk-free rates that makes cost of capital estimation harder. Credit market stress. Investment-grade credit spreads that were 100 basis points over Treasuries in 2021 ballooned to 200 plus basis points during 2022 stress. Then they normalized to 150 BP in 2024. If you calculated cost of debt in January using that 100 BP spread and applied it in December, like I mentioned earlier, you'd be meaningfully wrong. There is silver lining in this, so be encouraged. Learning these concepts during uncertainty forces you to understand the underlying economics, not just mechanically apply a bunch of formulas. When markets normalize someday, you'll be better at cost of capital estimation than people who only learned during stable periods. Now, today we talked about technical mastery. Some of the key ideas here are the takeaways. WACC calculation requires judgment, not just formula. Market values are mandatory for weights, no exceptions. Cost components must reflect current market conditions. Sensitivity analysis is professional standard, not academic luxury. In professional skills, the key takeaways are document assumptions clearly for future reference, present ranges with confidence levels, not false prediction, connect analysis to business decisions and practical implications, and update estimates as market conditions change. And then the third area of takeaway or WACC wisdom for today is strategic thinking. Cost of capital drives investment decisions and firm value. Different business units may require different WACCs. Market timing affects optimal capital structures, and uncertainty analysis builds stakeholder confidence.